Hey there, macro folks. This is Mr. Hooker. I'm just wanting to talk to y'all a little bit about monetary policy since '08. Up until '08, monetary policy was pretty simple. You had your basic all open market operations, the discount rate, and the changes in the reserve requirement. Since then, there have been some changes. We need to go over that. So let's get to that really quick. Let's look at it. So, the new tools of monetary policy in the order that they are used now. So, before '08, the primary tool was open market operations. That is now the least used tool. So, it fell out of favor, first to worst, basically, if you want to look at it that way. So, now the most used tool is the Fed pays interest on excess reserves. So, what we call the IOER rate, the interest on excess reserves rate. The second one, because not every financial institution is eligible to earn interest on excess reserves, they have to have another tool for that. So the second one, the Fed will borrow money overnight from financial institutions, and that's what we call reverse repo. So you have repos and you have reverse repos. And so reverse repos are basically the second most used thing, where basically the Fed's borrowing overnight from institutions, which basically serves as their second way to set that bottom bound for the interest rate, that lower bound. And then to set the upper bound for the interest rate, basically they change the discount rate. And so that helps set the upper bounds for any kind of interest rates that they may want. And then last is the open market operations. So let's look at these in turn. First off, Fed paying interest on excess reserves, the IOER rate. And so they will pay interest to banks on their excess reserve balances. So basically, you've got two sets of reserves. So you've got, banks are holding money, and you've got basically required reserves and excess reserves. So excess reserves are basically equated to loanable funds. It's the money you could loan out. You're not required to hold it, etc. So this is basically that excess balance, those excess reserves on top of what you are required to hold. So this effectively creates a minimum interest rate that banks will charge before lending out their money. So if that number gets too high, it basically will stop all other lending. So you can't get that. Fed can't pay too much for that because it will stop all other lending, because Fed is guaranteed to pay, right? Fed will always pay, and you and I and all that, as great as we think we are, we may not always pay. So don't take that personally, people. It's just the truth of the way it goes. So the way that goes is the Fed, just on history, since they will always pay, the banks will always take the Fed's money over personal money, right? Just the rate, the way that goes. So it creates that floor for the federal funds rate, and that's the rate the banks charge each other to borrow money. And so that happens at the end of the day. Banks look around. You have, do you have enough required reserves or do you not? And if you have enough, great. If you don't, you need to borrow money from a friend to have enough when 7 o'clock rolls around the next morning, in case they come and check you to see if you have enough. And so not every institution, as I mentioned, in the federal funds market is eligible to earn interest on their reserves. So the Fed has to use another method to create a floor for these institutions. So that leads us to reverse repos. So that's when the Fed engages in overnight borrowing from those financial institutions. So repos are basically when banks borrow overnight from the Fed. Reverse repos was when the Fed's borrowing from the institutions. So the basics are really simple. The Fed's borrowing money overnight from the institutions. It is backed by securities with the promise to pay them back with interest the very next day. That is a very liquid, very secure kind of loan. It's quick, it's highly liquid, it's highly attractive to financial institutions. And so that sets a floor to the federal funds rate for those types of institutions. Um, and that's primarily done with institutions that do not have access to excess reserve lending, it's excess reserve interest rates. The third method here really isn't used too much. It's called the discount window, discount rate. Changing the discount rate, but that comes with the discount window. Um, and the reason we call it the discount window is because at the Fed back in the day, there actually was a window where banks would go to sell their loans at a discount and then buy them back later. Um, Now that doesn't happen anymore. There's no real window at all these places, at all these Feds, where the banks will go anymore. Um, it's all done electronically now, but it's kind of crazy that that's how that goes. So the interest rate that the Fed paid on those loans was called the discount rate. And so when you think about that, the Fed was really like a pawn shop for banks. Um, so it's a glorified pawn shop in that sense. So the discount rate's typically higher than the federal funds rate and is usually like the upper bound for the federal funds rate. So, but it's possible. It is possible the federal funds rate could go higher than the discount rate for some odd reason. Some kind of as I think it was Greenspan put it. I think Greenspan was the one that coined that phrase, irrational exuberance. If you had some moments of irrational exuberance, the federal funds rate could go higher than the discount rate. And at that point, banks would just say, okay, bump the federal funds rate. We'll just borrow at the discount rate. Another reason banks don't like doing the discount rate is basically you're borrowing from the people who regulate you. That's a problem. Like, how much do you really want to borrow from your boss? If you think about it that way, like, that's not something you want to do too much. And then open market operations. So prior to '07, this was a primary tool. Now it's just really not that effective. It doesn't change the interest rate as quickly or as much as the Fed would like it to. So that's a problem. So that consists of buying and selling government securities at the open market trading desk, which is also referred to as the desk. And this is also where all the transactions for repos happen. So just pointing out, repos and reverse repos happen at the desk. So buying securities increases excess reserves and theoretically lowers the interest rate by making loanable funds more available. So the Fed buys securities, they take securities out of the banks and then give them money. When they give them money, all of that money is instantly excess reserves. And that basically just floods the market with excess reserves. And by doing so, everybody now all of a sudden has way more loanable funds. And to get rid of those loanable funds, they're competing with each other for loans. And to do so, to get their loans made, they have to lower the interest rate. So that's how that works. Selling securities would decrease excess reserves, theoretically increase interest rates by making loanable funds less available. So basically, you're taking excess reserves out of the market, selling them to basically selling securities to the banks. The banks are holding securities for which they're getting paid quarterly interest, but they don't have money now. They don't actually have those excess reserves. So now it's harder to make loans. You don't have as much money to make. You don't have as much loanable funds to make those loans. And now as people are coming to make loans, so you're basically going to have to raise the interest rate to make those, to get those loans. So people are fighting for the loans, and now you're basically raising the interest rate on them. The problem is, um, there's a lot of moving parts in this method, right? One, you're assuming that there are a boatload of people going to make loans, and you're assuming that all the banks are wanting to buy or sell securities, and you're assuming that all of these things are going to work at the same time. The banking system isn't really that fluid. Um, like, not everybody goes to the bank to get a loan. Not everybody does this at the same time. So these things become an issue. So using open market operations has been problematic throughout the whole of the 2000s. The Fed had actually been looking for new ways to move the interest rates more effectively. Then in '07, the financial crisis hits. And they were like, okay, perfect opportunity to test new ways and just find new ways to do this. And so they did. And repos were the new thing. So repos and interest rates on excess reserves became the new things, and that's what they moved to. And so and then they ended up mainly settling on interest on excess reserves. The first new thing was actually repos, and they moved that to second now, and IOER is basically the number one now. Hope this helps. Everybody take care. Have fun.